Your salary is $500,000 a month, but your employer gives you a car, pays your rent, and even feeds you at work. Did you know that the taxman looks at all of that and says, "This is income"? Welcome to A Stitch in Tax, Saves Cash, the show where we explain Nigeria's tax laws in a way that protects your pocket and keeps you compliant. I'm Olatunji Abdulrazak, founder and CEO of Taxmobile Online, and today we're breaking down a very important part of our tax system, Section 14 of the Nigeria Tax Act 2025. This is the section that deals with benefits in kind, which are also known as non-cash employment benefits. So, what exactly are benefits in kind? Simply put, they are non-cash rewards you get from your employer. Think about things like a company car, a paid-for apartment, furniture, a generator, meal vouchers, club memberships, or even relocation packages. Section 14 has a very important message. If you receive economic value from your employer, Nigeria considers it income whether it's in cash or not. Let's start with the most common one, company assets. If your employer provides you with a car, furniture, or any other equipment for your personal use, you are considered to have received a taxable benefit. So, how is this benefit valued? It's actually very simple. The law sets it at 5% of the asset's acquisition cost per year. What if the cost is unknown? In that case, it's 5% of the market value at the time it was acquired, as determined by the tax authority. The law deliberately avoids getting into complicated depreciation calculations or tracking how much you use it. It's a straightforward rule to keep things clear. Now, what happens if your employer rents or hires something for you? This could be a leased car, a rented apartment, or equipment hired for your personal use. Here, the rule is very strict. The full rent or hire cost that your employer pays is taxable in your hands. This rule is in place to prevent employers from trying to disguise salary as rent paid on behalf of staff. It ensures that all forms of compensation are treated fairly for tax purposes. What about other benefits that don't fit neatly into the asset or rental categories? For these, the rule is equally straightforward. Whatever your employer spends on the benefit is taxable. Let's say your company pays for your gym membership, a subscription to a private club, or other personal lifestyle perks. If your employer is paying for it for your personal benefit, then it is considered income and is taxable. It's all about the economic value you receive. But hold on, there's some good news here. If you personally contribute towards a benefit, your contribution reduces the taxable amount. For example, if you pay for fuel or maintenance on the company car, or contribute a part of the rent for your apartment, or even pay part of the purchase cost of an asset, any amount you contribute directly reduces the value of the benefit that is subject to tax. This is exactly why keeping proper documentation and records of your contributions is so important. Your payslips and bank statements can be your best friends here. Now, not everything is taxable. The law is fair and understands that some benefits are necessary for you to do your job. Section 14 clearly exempts certain items. First, let's talk about meals. Meals provided in a staff canteen or even meal vouchers given to you by your employer are not taxable. This is a huge relief for many employees. Second, work-related clothing and equipment are exempt. This includes things like company uniforms, overalls, protective gear like helmets or safety boots, and any tools that are required for you to perform your work. The principle here is simple. If the benefit is necessary for you to do your job, it should not be taxed. It's not a personal perk, it's a work necessity. Another important exemption is for relocation expenses. If you have to change your residence because your employer transferred you to a new city or because you are starting a new job in a different location, the costs associated with that move are not considered taxable income. This helps ease the financial burden of relocating for work. Now, let's talk about accommodation, because it's treated a bit differently and more carefully. If your employer provides you with a house, either free of charge or at a rent that is below the market value, the difference between what you pay and the actual market rent is considered a taxable benefit. This is treated as an additional part of your emolument. However, there's a very important protection built into the law to prevent you from being overtaxed. The taxable value of this housing benefit is capped. It cannot be more than 20% of your annual gross income. And when we say gross income, we mean your income excluding the value of the rent itself. This cap is a safety net. It ensures that employees are not unfairly taxed just because they live in employer-provided housing, especially in high-cost areas. So, how is the rental value determined in the first place? It is typically based on the local government's valuation for that property or an assessment made by the tax authority. And if you only occupy the property for part of the year, or share it, the benefit is prorated accordingly. Let's put some numbers to this to make it crystal clear. Imagine an employee who has a gross income of 15 million naira a year. On top of that, their employer provides them with a company car worth 12 million naira, housing with a rental value of 4 million naira per year, and meal vouchers worth 600,000 naira for the year. How would we compute the tax? First, the car benefit. We take 5% of the car's value, which is 12 million naira. So, 5% of 12 million is 600,000 naira. That's the taxable benefit for the car. Next, the housing benefit. The rental value is 4 million naira. But remember the cap. We calculate 20% of the employee's gross income, which is 15 million naira. 20% of 15 million is 3 million naira. Since the rental value of 4 million is higher than the cap of 3 million, the taxable housing benefit is limited to 3 million naira. What about the meal vouchers? As we discussed, meal vouchers are exempt from tax. So, the taxable value is 0. Now, we add up the total taxable benefits, 600,000 naira for the car, plus 3 million naira for the housing. That gives us a total taxable benefit of 3.6 million naira. This amount is then added to the employee's regular employment income for the purpose of calculating their pay-as-you-earn, or paid tax. So, what are the key takeaways from all of this? For employers, it's crucial to keep proper records of asset costs and rental values. You must report these benefits in kind accurately under the pay system. It is also wise to structure your compensation packages in a way that is tax efficient for both the company and your employees. For employees, the main lesson is that non-cash benefits are not tax-free. They have real value and are often taxable. Always keep proof of any contributions you make towards these benefits, as they can reduce your tax bill. And finally, make sure you know which benefits are legitimately exempt from tax. Section 14 of the Nigeria Tax Act 2025 is all about fairness and transparency. It ensures that a person's employment income reflects the real economic value they receive. It protects benefits that are necessary for work, taxes accommodation benefits fairly, and makes sure the pay system remains transparent and enforceable. At the end of the day, the message is simple: cash or not, income is income. If this explanation helped you understand your taxes a little better, please give this video a like and subscribe to our channel. A Stitch in Tax saves cash. Don't forget to turn on notifications so you don't miss our next video with more practical tax insights. I'm Olatunji Abdul Razak. And remember, A Stitch in Tax truly saves cash. Thanks for watching.